Hey friends, welcome back to the channel. I'm Iggy, and I've been diving deep into topics like stocks, finance, and everything related to growing your wealth, no matter where you are in the world. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. If you're looking for that edge, stick around and consider joining our community for even more insights. Picture this scenario. You wake up one morning and discover that one of the world's most stable investments just got dumped by smart money. We're talking about German government bonds, the financial equivalent of a rock-solid savings account. In April 2025, Japanese investors sold off a massive $10.4 billion worth of these bonds. That's the biggest sell-off in over a decade. Why should you care about this? Because when institutional investors with trillions under management make moves this big, it sends shockwaves through global markets. Today, we'll break down what triggered this massive exodus, why it matters for your portfolio, and most importantly, how you can position yourself to benefit from these seismic shifts in the bond market. Let's start with what actually happened. Germany made a huge announcement in March 2025 that caught everyone off guard. They decided to throw their famous fiscal discipline out the window and announced a 500 billion euro infrastructure spending spree. Think of it like a family that's been saving every penny for decades, suddenly deciding to renovate their entire house and buy a new car. This wasn't just any announcement. Germany has been known for its debt brake, which are strict rules that limit government borrowing. It's like having a personal spending limit that you never break. But faced with aging infrastructure and the need to boost defense spending, they said enough is enough and decided to loosen these rules. The market's reaction was immediate and brutal. German bond yields, that's the interest rate the government pays to borrow money, shot up by 50 basis points in just weeks. To put this in perspective, that's like your mortgage rate jumping from 3% to 3.5% overnight. For bond investors, this means the value of their existing bonds drops significantly. Now here's where it gets interesting for us as investors. Japanese institutions aren't just any investors. They're some of the smartest money managers in the world. They saw what was coming and decided to cut their losses. But here's the twist. While they were selling German bonds, they were buying European stocks like there's no tomorrow. Our premium members got detailed analysis on this exact trend 2 weeks before it hit mainstream media. They're already positioned in the European sectors that are benefiting most from this shift. The numbers tell a fascinating story. While Japanese investors were dumping German bonds, they poured over 1 trillion yen into European stocks in the same month. That's like selling your savings bonds and buying growth stocks instead. They clearly saw better opportunities in European companies than in German government debt. But wait. There's more to this story. Remember, this all happened during a period of massive trade tensions. The US was implementing new tariffs, creating uncertainty in American markets. This made European assets look even more attractive as a safe haven alternative. Think about it this way. If you had to choose between lending money to a government that's about to go on a spending spree or buying shares in solid European companies, which would you pick? The smart money chose companies over government debt. What does this mean for your portfolio? First, it signals a major shift in how institutional investors view European assets. When the biggest players start rotating money from bonds to stocks, it often marks the beginning of a longer-term trend. European stock markets have been on fire this year. Italy's main index is up over 17%, while Spain's is up an incredible 26%. These aren't just random numbers. They represent real opportunities for investors who understand what's happening behind the scenes. Our daily premium insights have been tracking these European opportunities for months. Members are getting specific stock picks and sector rotations that most investors won't hear about for weeks. Here's what I find most fascinating about this whole situation. The German government's decision to spend big isn't necessarily bad news. In fact, it could be great news for European economic growth. When governments invest in infrastructure and defense, it creates jobs, boosts productivity, and can lead to higher corporate profits. The key is positioning yourself correctly. Instead of fighting this trend, smart investors are riding it. They're reducing their exposure to government bonds and increasing their allocation to European equities, particularly in sectors that will benefit from increased government spending. Let me break down the practical implications for your portfolio. If you're heavily weighted in developed market bonds, more than 15% of your total portfolio, it might be time to rebalance. Consider shifting some of that allocation to European stocks through globally available ETFs. The infrastructure spending in Germany isn't happening in isolation. Other European countries are also ramping up their defense and infrastructure investments. This creates a rising tide that can lift many boats in the European stock market. But here's where timing becomes crucial. These shifts don't happen overnight, and the early movers often get the best returns. The Japanese institutions that sold German bonds in April were positioning themselves ahead of what they saw as inevitable changes in the European financial landscape. For individual investors like us, this presents both opportunities and challenges. The opportunity is clear. European stocks are still trading below their historical averages despite recent gains. The challenge is knowing which specific sectors and companies will benefit most from this fiscal expansion. This is exactly the kind of analysis our premium members receive daily. While everyone else is reading about these trends in the news, our members are getting actionable insights that help them position their portfolios ahead of major market moves. The currency angle is also worth considering. The euro has been strengthening against many currencies as investors gain confidence in European growth prospects. This adds another layer of potential returns for international investors. But let's not forget the risks. Increased government spending can lead to higher inflation, which might force central banks to keep interest rates higher for longer. This could create headwinds for some sectors while benefiting others. The key is diversification and staying informed. Don't put all your eggs in one basket, but also don't ignore major trends when they're staring you in the face. Now here's my personal take on all of this. I see this German bond sell-off as a canary in the coal mine. It's signaling a broader shift from the low-growth, low-inflation environment we've been in for years to something more dynamic and potentially more profitable for equity investors. My recommendation: if you're not already exposed to European markets, consider allocating 5 to 10% of your portfolio to European equities. Focus on sectors that will benefit from infrastructure spending. Think construction, materials, and technology companies that support digital infrastructure. I'm personally bullish on this trend. The fundamentals are strong, the valuations are reasonable, and the smart money is already moving. This isn't a short-term trade. It's a structural shift that could play out over years. For those of you asking about specific timing, I'd say don't try to time the market perfectly. Start building your position gradually and stay disciplined. The Japanese institutions didn't dump everything in one day. They made strategic moves over time. To wrap this up, the great German bond exodus of April 2025 isn't just a footnote in financial history. It's a signal that the investment landscape is changing, and those who adapt early will be best positioned to benefit. The key takeaways: government fiscal policy changes can create massive investment opportunities. Smart money moves before the crowd catches on. European equities are looking increasingly attractive compared to government bonds. And diversification remains your best friend in uncertain times. Before you go, if you found this video helpful and want to seriously level up your investing game, imagine getting daily premium insights delivered to you up to a week before anyone else sees them. That's what our members get for just $1 a month, less than a cup of coffee. Think about it. Consistent, early access to valuable information that can truly accelerate your financial journey, no matter where you are. Ready to join the inner circle? Just click the link in the description below to become a member.